So, look, I mean, this is a question that gets a lot of debate. It's been getting debate for many years, and pretty much since indexing and ETFs have become much more popular and have been taking a large part of the flows. So there's two answers to this. And the large answer, I mean, the big answer, the predominant answer is that it's actually not having a meaningful impact on markets. There's the distortion in large parts of the marketplaces are, de minimis, if at all. And just to give you context, it's just people don't really have all the numbers, but a $25 trillion market for mutual funds in the world, and a $4 trillion market for ETFs. And then, of course, there's a larger indexing marketplace. The bigger issue is that, of the 25 trillion in mutual funds, on top of the indexing, you still have a large part of what I call closet indexing. So large cap and investors that follow the major market indexes as their core holdings. And so, that has a greater impact versus just indexing. The second part of the question is where it actually does see this issue is that when you get into sort of what I call illiquid or smaller market areas, and surprisingly, this can be, of course, small cap stocks and certain subsectors like marijuana indexes or junior mining indexes, but also things like high yield bonds and certain bond areas. This is where, no question, market flows, whether that be active or passive, do have a meaningful impact on distorting prices. And so we're seeing that play out today in Canada in the marijuana sector, where the marijuana index is pretty much a major player in the buying and selling of the asset, and therefore distorting, lifting all boats at one time, where there are good companies that can win and some bad companies that will likely just are benefiting from the tailwinds. And our view is that type of distortion is bad for the marketplace. And ultimately needs to get sorted out, and actually does open up for significant arbitrage opportunities, because of the indexing type of flows. So, but I think in summary, like in general, I think that people make a bigger deal out of this than it is at the high level. So the S&P 500 is not being distorted by index flows today. But no question, when you start getting into certain areas, we saw this in gold. We've seen that in the bond market quite dramatically. And we all, as investors, need to be concerned about that at times. You can also take advantage of it at times as well as an investor.